You are holding the stock into the close. The numbers hit at 4:01 p.m. Revenue beat, earnings beat. You feel that little flush of being right, the one you have been waiting on all quarter. Then the after hours quote turns red, down 9% in about 90 seconds. You did everything right. The company did everything right. And the money is just evaporating in front of you. Here is what took me an embarrassingly long time to understand. The report is almost never about the report. A company can beat on revenue, beat on profit, raise the dividend, and still get taken apart in seconds. It happens every single season to good companies in front of smart people. And almost everyone walks away thinking they misread the business. They didn't. They misread the thing underneath it. My name is ST, and I spend way too much time trying to make sense of the market. If you have ever watched good news punish a stock and felt like the rules were written in a language nobody taught you, subscribe and stick around because that language is the whole game. And once you can read it, earnings season stops happening to you and starts making sense. So let me hand you the first word of it, and it is a number almost nobody says out loud. Over the last 10 years, roughly 3 out of 4 companies in the S&P 500 beat their earnings estimate every quarter. Read that again. Beating is not the achievement. Beating is the baseline. The analysts set the bar low on purpose. The company guides you under its own number. Everyone does this quiet little dance, and the stock clears a hurdle that was lying on the floor. So when a headline says beats estimates, you are reading the most common sentence in all of finance. It tells you almost nothing about which way the stock is about to move, because a stock does not price what happened. It prices what everyone already decided was going to happen. And those two things are almost never the same. Sit with that, because everything strange about earnings falls out of it. If a stock runs 20% into the report because the whole market already knows the quarter is going to be good, then a good quarter is not new information. It is a bill coming due. The people who were going to buy already bought weeks ago in the run-up. So the report lands, the quarter is beautiful, and the only thing left for the smart money to do is sell into the good news and book the gain. Traders even have a name for it. Sell the news. The beat was real. It was just already spent. Then it gets stranger. There is the estimate everyone can see, the official consensus number. And underneath it, there is a second number, unofficial, higher, the one the big desks actually trade against. People call it the whisper. So a company reports $1.20 against an estimate of $1.10, the headline screams beat, and the stock drops because the rooms moving billions were quietly expecting $1.25. You cleared the bar you could see and tripped over the one you couldn't even. And then there is the future, which is where the real damage lives because a stock price was never a grade for last quarter. It is a bet on every quarter that comes after. So a company can hand you a gorgeous 3 months and then, in one sentence on the conference call, trim its guidance by a hair, and the stock falls off a cliff while the anchor is still reading the good headline out loud. Netflix did the first half of exactly this in April of 2026. It beat on revenue and on earnings, a genuinely strong quarter, and the stock fell about 12% because management held its outlook flat instead of raising it. To a price built on acceleration, flat reads as a warning. The present beat the estimate, the future blinked, and the future always wins. Now here is the part that tells you this is not some modern glitch in the machine. It is just how expectation works, and people have been measuring it for decades. Back in 1989, 2 researchers named Bernard and Thomas documented something they called post-earnings drift. Stocks do not react to the raw result. They react to the surprise, the distance between what was expected and what actually showed up, and then they keep drifting in the direction of that surprise for weeks afterward. That is the secret, and it has been sitting in plain sight in an accounting journal for over 30 years. The market never trades the news. It trades the gap between the news and the expectation, and the expectation is invisible. It does not print anywhere in the headline. Which means something a little uncomfortable. By the time you read the words beats estimates on your screen, the trade is already over. That violent little move in the first 60 seconds after the bell is not the market digesting the press release. It is the market settling a bet that was placed long before you ever saw it. The institutions modeled this quarter back in the winter.
They had the whisper number, the channel checks, an analyst on the call ready to pounce on a single line about margins. You are reading the headline. They are reading the footnote and the tone of the chief financial officer's voice. That is who is on the other side of your earnings trade, not the company, the people who already priced the company. And nobody is hiding any of this from you. There is no vault, no secret memo, no conspiracy. The expectation is simply quieter than the headline, and the headline is the only part most people ever bother to read. So here is the thing that reorders the whole picture once you see it. If beating is already assumed, then every great quarter does not lower the bar for next time. It raises it. The better a company does, the more the price quietly demands, the more flawless the next report has to be just to keep the stock standing still. That is why a genuinely excellent business can be a miserable stock to own. When a company is priced for perfection, merely great is a disappointment. Good news becomes the most expensive thing you can buy because the price already swallowed it whole. So go back to that moment at the start. Green report, revenue beat, earnings beat, and the screen bleeding red anyway. That gap between the good news in your hand and the red on the screen was never a glitch, and it was never unfair. It was the market quietly telling you that the news was never the point. The expectation was learn to see that second number, the invisible one, the one nobody ever prints, and the red stops feeling like a betrayal and starts looking like the most honest thing on the screen. I'll see you on the next one.